the first thing some people might say, it's like, well, the U.S. Federal Reserve does not affect Canada. It's like, U.S. bonds are our reserve asset, people. Like, we don't have any gold. We do not have any gold. And I pull up on here, this is from the Bank of Canada website. It actually shows our reserves. Okay, so our reserves, and this is in millions of dollars, so 68 billion US dollars, okay? We have 30 billion of other foreign currencies, and then we have 23 billion of special drawing rights and 4 billion of reserve position IMF.
Wait one cotton picking second. Look at how much gold reserves Canada has.
Zero.
That is more scary than anything else in this particular climate, but hey.
And special drawing rights, if you could just rename it, these are IMF bucks. So these are International Monetary Fund bucks. Like, this is what they are. They're a basket of currency, which is also majority US dollars. Like, yes. That's in effect, right? And so this here is straight up. And when they say US dollars, they're not just sitting around holding cash. They're holding US treasuries or US bonds earning a return, okay? So, so 68 billion is directly in US bonds, okay? 23 billion is in special drawing rights, which is effectively a basket of currencies, mostly US dollars, okay? So out of the $128 billion in reserve assets that we have, let's call it 90 billion is US dollars. This is our reserve asset, people. This is the interconnectivity of the system, okay? It goes beyond that. It's not just what our reserves are. It's like what the interest rates. We're not going to have 1% interest rates here and 10% in the U.S. It's not going to work that way.
Right.
Okay.
And people also have to remember that when it comes to currencies, right? We're always measuring our currency against the U.S. dollar.
Yes.
So anybody who is trading back and forth, if we're selling goods into the U.S. or if we're buying goods, it's all transacted at that differential between the U.S. and Canadian dollar. So for people in Canada who manufacture goods here and sell them into the U.S., of course they make that 30% bump sans tariffs, but so it does matter what happens with the Federal Reserve.
Exactly. And so I'm going to go straight first. I'm going to look at on the U.S. end what is happening in terms of the U.S. charts. Then I'm going to tie that back into how that affects what happens in Canada. And then we're going to finish on what I think maybe you should do about it.
All right, let's do it.
So, the first of all, what did the gold market think of Kevin Warsh? What did the gold market? Remember, we had an all-time high of $5,600 US dollars per ounce, right? Oh. $5,600 US dollars per ounce. So I remember sitting here.
How many snow pesos is that?
Yeah, like I was sitting here, yesterday, the day before, looking at this at 7,000 Canadian dollars at the beginning of the day, thinking it was 7,500 Canadian dollars at the end of the day.
Holy moly!
It's just wild. This is an ounce of gold that I used to buy for 2,000 Canadian dollars, right? So the gold market sold off. Now, a lot of this is just like, was it just overbought and it's just a natural pullback? Sure, but like some of it is it's Kevin Warsh, right? Because there were other alternatives there. There were other alternatives out there who were more, I don't know if dovish is the word, but it's more just like they're just going to print till their eyes bleed, like the cartoon character who's printing the money, right? Like there were some other kind of real wild ones out there, and I really think that this had the lead up to the gold prices because people are like, oh my goodness, if these guys are in charge, like they're just going to print this thing into oblivion, okay? Kevin Warsh is going to do something a little bit different, and one, a solution that I don't think has been like well talked about, because it's pretty much like, let's be a hawk and not, let's be a hawk and raise interest rates and shrink the balance sheet of the Federal Reserve, or let's be a dove and lower interest rates and expand the balance sheet of the Federal Reserve, right? But Kevin Warsh is different. He wants to push one of those levers in one direction, and he wants to pull the other lever in the other direction. That's interesting. It's unique, okay? And I want to explain that to people, okay? So but also The Bitcoin market also didn't like Kevin Morris. They wanted one of these BlackRock guys. They wanted the BlackRock guy to come in here and, you know, just expand the balance sheet and lower the rates and like let's cause the chaos. And let's cause $1 million Bitcoin tomorrow. Let's cause $10,000 ounces of gold, $1 million Bitcoin tomorrow. Like here's where we're going, right? But that didn't happen. Okay, so overall, in the short term, you know, the gold market and the Bitcoin market reacted negatively to this Federal Reserve appointment. Okay, but he's not really a dove and he's not really a hawk. Okay, there's a lot of nuance to this, and it's very important to understand. So, what is the Federal Reserve balance sheet? So this is the Federal Reserve balance sheet for approximately the last 10 years. Okay. And actually this goes all the way back to 2008, and you can see the massive expansion of the Federal Reserve balance sheet from, you know, let's call it $4 trillion to all the way up here to $9 trillion. And finally, we've normalized somewhere around $6.5 trillion. Okay. So what did that expansion of the balance sheet do when the government, when the Federal Reserve creates new money with a click of a button and goes out and spends that money primarily on bonds? That money gets injected into the system. Those bonds come back to the Federal Reserve. Okay. What that does is increase the money supply. And so here is the money supply in the last 10 years. It goes from $12 trillion, okay, all the way up in the U.S. to $22 trillion. Okay. Double the money supply. Double the money supply in 10 years. Now, did the population double? No. Does that look like a 2% growth rate, what they tell us what the inflation is? No. You start to calculate this, you start to get the real inflation of like what it actually feels like when you go out and purchase goods and services, and certainly desirable assets, where most of the excess cash flow ends up going, because the people with money don't go buy, you know, 4 steaks for dinner every night. They buy 1 steak for dinner every night, and the excess cash goes to desirable assets.
Yes.
And so that's what happened, you know, so that expansion of the balance sheet, okay, is what happened. Okay. Now, why does that balance sheet need to expand? It's like, you know, what is happening here? Governments aren't going to balance their budgets, okay? The U.S. government, $1.7 trillion deficit, okay? This $372 billion in tariff revenue. Hopefully, if it doesn't get, you know, struck down by the Supreme Court, maybe that's coming to the coffers. Maybe it's not, right? You know, $2 trillion, $1.7 trillion. Okay, people aren't ready for a balanced budget. They're just not ready for that discussion. This is not a question of who you vote for. This is a question of the people voting for the people.
Right, because they always vote for the people who want to give you free stuff.
They're not.
They're going to give you free things. We're going to make life better for you. We're going to pay for this and pay for that. And they vote for it, but they don't realize the consequences of their actions. And the other distraction that we see are the people who are hawks, and they want to, you know, have a balanced budget. We want to reduce the amount of spending that we're doing, that putting the burden on the taxpayers and their children for generation after generation. So those guys, they get their group of people who are on them, and they're like, yeah, we're supporting that. That's amazing, because you think of a household budget, a balanced budget, like otherwise you're not going to go bankrupt. You're going to be able to feed your kids. So they're thinking it in the same terms, but really in reality, if we did that, it would ruin everything.
Yeah, like the people aren't ready for the solutions. No. Even the people who talk about balanced budgets don't actually mean balanced budgets. They just like talking about balanced budgets.
No
because
Social Security.
They just don't want to talk about, like, this is the Western world where like the balanced budget is only possible if you start, you know, having serious discussions about healthcare, seniors benefits, military spending. And once you start talking about that, you become a political pariah. You don't get elected. It doesn't matter if you're Donald Trump or Kamala Harris or Mark Carney or Pierre Poilievre. It's like, they'll talk about fiscal responsibility, but they won't talk about the issues where you could actually be fiscally responsible. They'll talk about tertiary efficiencies that seem fiscally responsible, but are smaller, much smaller line items in the budget, which don't make it possible. Right?
Case in point, right now they're talking about all the fraud that they're uncovering in where is that? Minnesota, right?
Sure.
Talking about all of that.
If they shut down all the Smalley daycares in Minnesota, we're going to balance the budget. They're going to balance the budget. Should they shut down fraudulent daycares?
Of course.
Yes. Is it going to be material in the 1.7 trillion? No. It's just not, right? Is there other elements of waste out there? Yes. Is there some people out there who are 120 years old still collecting Social Security? Yes. Is there enough of them to make the Social Security number to go down from 1.6 trillion even to 1.5 trillion? No. It's just the materiality of the amount. And so it has an upper limit in terms of the fraud and waste. Eventually, if you really wanted fiscal responsibility, you have to make really tough choices, not just the ones that sound. It's easy to try to convince people that it's all fraud and waste. The whole thing is fraud and waste. No, some of it is programs that the taxpayer, the elector actually wants. They probably shouldn't want because they're just paying through inflation, right? But they're not ready for that. They're not ready for that. Okay.
$35 veggie trays have to, they pay for something, folks, right?
You think it's free. It's not free. You're just paying with the devaluation of your currency and wages. So, okay. So what does the Federal Reserve get to decide this? Okay. The Federal Reserve gets to decide the expansion or the contraction of the balance sheet. There's basically three roles of central banks. They can expand or contract the balance sheet. They can raise or lower short-term interest rates, and they can change bank and lending rules. These are the three tools. They talk about all the tools and the tools. There's three. A hammer, a screwdriver,
pliers.
That's it. They got these three tools, and we're going to make it overly complex and confuse everybody, because if you told them simply, they might start rioting in the streets, right? But so these are the three tools in the tool chest that they have. Okay. And people say the common one is they don't affect the long-term bond rates. The bond rates is set by the market, except for the fact that they can print fake money, go out in the market and buy long-term bonds, people. That they do affect the long-term bond rates, because if they had no balance sheet, sure, that might be the case, right? But if the balance sheet includes long-term bonds, you 100% can affect the rate, right? If you got, $6 trillion at your disposal to go out and buy long-term bonds, you better believe you can affect those long-term bond rates, right?
Yeah, for sure.
That's a lot of money, right? And so here's where we are, where this is, what people have been thinking is that there's going to be a Federal Reserve individual in there who is going to be contracting the balance sheet and simultaneously increasing the short-term borrowing rates. Okay, the hawkish stance, or the dovish stance, is I'm going to be increasing the size of the balance sheet, so injecting cash flow into the system, and lowering the short-term interest rates to make it easy to borrow. Okay, Kevin Marsh is different. Kevin Marsh is, I want to, I'm not sold that he wants to materially shrink the size of the Federal Reserve balance sheet. He's talked about it, but I think he votes for prudence. He did not want to see the size of the Federal Reserve balance sheet go from 4 trillion to right here 9 trillion. Mm-hmm. You know what I mean? He thought that was irresponsible, right? So whether he wants to shrink it or maintain it the same, he wants to be hawkish in that he wants to control the size of the Federal Reserve balance sheet. But he's dovish in the fact that he wants to lower short-term interest rates. Okay? And so that's, you basically have two levers pulling in different directions, right? And what effect is that going to have? So the short-term interest rates is pretty easy to understand. So that short-term interest rate in the U.S. right now is, 3.75%. They have their range or whatever. Let's call it 3.75%. So he wants that lower. Okay. And simultaneously, this balance sheet, he's going to keep it the same or shrink it, or prudent growth, maybe. Right. Mm-hmm. But it, does not want this explosion. That's what he was critical of. Okay. Now,
I did have a question about that. Just popped into my head here. When it comes to that, where he wants to maintain the balance sheet, mm-hmm. where it's at. What about places like Japan and others that are selling off their bonds, how does that? Because I mean, the Fed has to buy those. So wouldn't that increase the balance sheet, or am I misunderstanding something?
Yeah, like if Japan's rates go up, you have capital flee the U.S. system to go repatriate to Japan. So it exerts downward pressure on the U.S. stock market and the U.S. bond market. So it's not just bonds; it's also the stock market. Because if you can borrow cheap money in Japan and invest overseas at better rates, it's like there's the carry trade, right?
Yeah.
So I mean, that does it affects it. It does affect it, right? And Japan is the largest holder of U.S. treasuries. But I also want to put this in perspective too. So Japan, I think Japan might have dropped below $1 trillion, in U.S. treasuries. Okay, but this next chart I'm going to show, it might grasp some, materiality to how much that means, right? Because the number's in the details. And I think when you start stripping away all the crazy amounts of zeros after the numbers, it starts to become kind of simple. So Japan has $1 trillion of U.S. treasuries. Okay. Let's say if they sold off a U.S. treasury, $1 trillion. Okay. Where does it have to go? Straight on the Federal Reserve balance sheet. So that might be the quick rational thinking. But I want to show this next chart. So this next chart is very, very important. Okay. This is the total money market funds in the U.S. The money market funds have increased from 3 trillion to, let's call it 8 trillion. Okay. So from 3 trillion to 8 trillion, primarily in the last 5 or 6 years. Okay. Now, why would people put money in short-term money market funds? It's because of this here. It's tied to this. If short-term interest rates set by the Federal Reserve are 0, the motivation to put money in a money market fund earning 0 is nothing.
Right.
Okay. If short-term interest rates set by the Federal Reserve is high, all of a sudden I have, an ability to get a predictable yield, and I don't have the risk that goes with long-term bonds. Okay, because when you have bonds, you have 2 risks. There's 2 risks when it comes to bonds. It's the issuer risk. Is the issuer going to default on the payment? Okay. So theoretically, if it's the issuer is the government, okay, whether it's the federal, whether it's the U.S. government or whether it's the Canadian government, they don't really have an issuer risk because they can print the money to pay you back, okay. But the second risk, it's not a default risk; it's duration risk. Okay, if you have a long duration product, if interest rates change a little bit, the value of that bond is a lot because the value change of price of that bond is a lot because the duration between when you make the investment and get your face value back is a long time in the future. Whereas a short-term product, if the desirability of that interest rate changes over time, it's not a big deal because you're getting paid back in 30 days, 90 days. It's not a big deal. Okay. So this becomes a very predictable way. That's why with this short-term rate high, that's why a lot of capital has flown in to money market funds. Okay. And this is a little bit like money market funds are, they're kind of part of M2 money supply and kind of not part of M2 money supply. So you see the M2 money supply going from 12 trillion to 22 trillion. So the kind of the plumbing behind the money market funds is basically these money market funds that are owned by retail investors and small businesses, small corporations. They're actually included. They're part of the 22 trillion, whereas money market funds owned by institutional investors are actually not part of the M2 money supply. Okay, so I believe approximately 30-40% of this 8 trillion, so let's call it 3 trillion of the 8 trillion is already part of the 22 trillion. It's part of the same number. Okay, but with $8 trillion here, $8 trillion who currently today, at fair market, whether you agree with it or I agree with it or not, has decided that they're going to put that, $8 trillion to work and have no duration risk because this is short-term products in exchange for, let's call it 3-4%. Let's call it 3%. Okay, and that's not just a U.S. thing. That's globally. Like we have money market funds in Canada. There's money market funds in Europe. Yeah. Okay, so they've decided that that's the best use of their capital. Okay, now if short-term rates come down, there's no expectation that that same number of people will keep those money in money market funds.
Right.
Okay.
So it's got that capital will flee. It's got to go to a more desirable
something else that pays a higher rate of return. Right. So the problem is that the U.S. Ultimately, when you're a politician, you're kind of a bond salesman. I'm going to call them. I'm just going to boil them all down. It's like effectively they're bond salesmen because they don't want to balance the budget. Balancing a budget is basically political suicide, and that's not a Republican Democrat issue. That's not a conservative liberal issue. It's the electorate has not made the decision to, they actually want these choices. The viewers of this show might want those choices, but I guarantee you that 99% of the population is not ready for these choices yet, right? They're not ready. Someday they will be. Yeah. Someday they will realize that they were never getting anything from free, but it's not going to be tomorrow, right?
Slash Social Security. Get rid of the healthcare spending.
Oh yeah,
military budgets.
Yeah, like it's just not functional, right?
My heads would explode.
Yeah. So there are free Canadian healthcare. It's free to go and sit in the waiting room and die, basically. Like that's the it's free though. But
or you can take the fast track and just get mated out of existence, right?
Yeah, but it's free, right?
It's free. That's right.
Okay, so this here, like they have to protect the long-term bonds. And like this is the point where people say, yeah, the market decides the long-term bonds rate. Yes, initially, but remember, the Federal Reserve can come back in, and if basically these yields climb too high, so when they climb higher, it means the price of the bond goes down. They're less desirable. So instead of buying a bond for $1,000 face value, if I buy it at a discount for $950, my effective yield goes up, right? And yes, the Federal Reserve does not set, they don't go out and, just authoritarian say what the long-term bond rate is, but they have the bazooka to step in and alter the market to what they want it to be.
They can just print the money to adjust the value.
They can print the money. They can go and buy. They can create basically an unlimited bid for those bonds and drive the price of the bonds up and the yield down, or they can sell it off, in which case the price of the bond, long-term bonds goes down, the yield goes up. Okay. So hopefully we're good on that. Like there'll still be someone in the comments that says that they don't control the market. It's like, I know they don't control the market, but they're the biggest buyer and affect the price, right?
That's right. Yeah.
It's like that's how it works. And so, going back to the Japan thing, it's like, how significant, and people talk about that carry trade. Mm-hmm. They got $1 trillion. There's $8 trillion of capital in short-term money market funds, just in the U.S. Just in the U.S. If Warsh executes his position and lowers rates, like the money's coming out of here. All of it? No. I mean, there was $3 trillion before when interest rates were, closer to zero, right? Or much lower. Okay. So, let's call it, there's $4 or $5 trillion of capital. If rates come down, that it's going somewhere else. And so that's 4 to 5 times Japan. Okay. And this is not, this might be the largest money market fund in the US, but it's not the only one.
Mm-hmm. Right.
There's lots of capital tied up in short duration instruments right now because of the short-term rates are high. So the idea is that if they can lower short-term rates, okay, they will have a bid for these bond prices. Okay, so they'll be able to, get this interest expense down, because this is going to climb to over $1 trillion, just rolling over $38 trillion.
Oh, yeah, they've got a warning label right there, a little warning sign right beside the interest on the debt.
Yeah, the nuclear bomb warning, right? Like eventually we head towards where this interest on long-term debt is the same as the tax revenue collected, and that's when it's over, right? But we're a long ways away from that, But
We're one war away.
Oh, yeah.
Just speculating, folks. I'm
Hopefully.
just making stuff up.
Hopefully not. Hopefully they avoid nuclear war before they gets there. Hopefully. And so this interest in long-term debt, just to roll this over, to roll $40 trillion over at 4%, like this goes to 1.6. Okay, goes to 1.6 trillion, right? So just I tell people, just simple math, get rid of the zeros, like 40 trillion, 4%, 1.6. That's a problem because you're already a deficit of 1.7. Your deficit is at 1.7 of a GDP of 31, right? Like that you're not growing the economy by the same speed that you're growing the debt. Okay. No, the robots aren't coming in and magically going to grow it that way. Like that sounds great, right? The universal high income, right? Yeah, I mean, that guy's trying to sell something too. He's got some robots to sell you. So